finance, a la shmup. What are above par, below par, and at par? All right, first, what is at par? And yeah, this, maybe not enough to make the tour, but not too shabby. But what about in the finance world? If a bond or other debt or preferred stock is trading at par or at 100, it's trading at face value, and investors buying the bond expect to get a return that matches the bond's coupon or interest or distribution rate. At par bonds are rare though. Most trade either above or below par. Well, when interest rates drop, investors are willing to pay more for older bonds with higher coupons, and bonds will then trade above par. When interest rates increase, well, those lower interest rates look about as appealing as mold on your roast beef sandwich, and bonds will trade below par for less than the face value. Well, interest rates aren't the only things that affect a bond's ability to trade at par, by the way. Company news can affect it as well. Like if an alien spaceship attacks your factories and kidnaps your staff, well, your bond's value likely will decrease. So let's say a bond yields 7%, meaning that for each $1,000 you get $35 paid to you twice a year. Well, this bond was issued 8 years ago, and now similar risk bonds have gone way up in price and yields have gone way down. So this bond might be quoted at 110, meaning that you pay $1,100 for that same sheet of paper today, so that your yield is not in fact 7%, but rather 10% less than 7% because you've paid 10% more for the bond. That is, you paid 10% over par. That new yield is 6.3%. You paid 10 points over par for the same $35 twice a year that you're getting. So that's above par, below par, and at par. If you're ever more than 30 above par, well, there's probably at least one club stuck in a tree somewhere or swimming in a lake.